to the show. Thanks for coming on.
Thanks for having me, Roland. Nice to be with you.
Yeah, you too. It's been good to get this in the diary. It's funny how these kind of this lockdown has inspired people to start like talking.
Yeah,
We've been following each other on social media probably for a little while. So no, it's really good to be doing this. So just people listening and watching who don't have sort of context for kind of who you are and what you do, kind of in brief, sort of what is your sort of property business look like?
Yeah, so my name's Charlie and my wife's name is GIleng, and together we founded Capstone Fox back in 2017, which is a property investment and development company. And over the last few years, we've been buying single lets, buy-to-lets and HMOs, mainly in the northeast of England, and transitioning from full-time corporate jobs, one in banking, so G works in the banking sector and I was in offshore engineering, and we've transitioned now into full-time property, and along with a couple of kids and one more on the way. So there you go. That's us in a nutshell, basically.
Good stuff. And what Charlie didn't mention there is that the due date is today, so we're hoping that we can finish this call before he has to run off.
Yeah, I might have to go halfway through, but hopefully...
Yeah, that's all right. I'll finish off without you, don't worry. So cool. So actually, so I mean, one of the things where I sort of like made a connection with you earlier on was that you worked in, you said offshore engineering, was that predominantly oil and gas stuff or other?
Yes. So I started off in the oil and gas sector, designing equipment for the back of ships, basically.
Yeah.
And then I moved to a company that worked actually mainly in offshore wind, and I was looking after the oil and gas division of that business. So it's subsea engineering. Yeah.
And for people that are listening that don't know, I also worked in oil and gas, but in a completely different part of it. So I was in investment banking for 10 years, advising oil and gas companies on capital raising, M&A, asset acquisitions and disposals. And it is a really fascinating industry, but at the same time, I mean, we're seeing it right now, like it's very volatile, right? And seemingly increasingly volatile. I mean, commodities are cyclical, but the sort of the highs and lows and the speed at which it moves from a high to a low is pretty dramatic, and that can be quite stressful, right? In the way it knocks on, the knock-on impact that it has to your job and your business.
Yeah, and it can take quite a long time to recover when there is a downturn or a recession, and we certainly saw that. Mainly, I mean, I was in that industry for 10 years, and it was probably 2015 when we felt it the most. When oil dropped from $100 a barrel to $20 a barrel. Yeah. And you thought it couldn't go any lower. So massive industry, a lot of people involved in it at lots of different levels, but very very difficult sometimes to transition through those periods, because it's like turning an oil tanker, at sea. You can't do it quickly. You've got to come out slowly of these things, and before it picks up again.
Yeah, exactly. And particularly if you're if you're exposed more to sort of the capex cycle, then projects just get sort of switched off or put to the back of the queue pretty quickly, right? If they're not already committed to. So, I mean, it's funny you mentioned 2015. So, we had our first daughter was born late 2014, and that it was almost exact timing was when the oil price kind of started to come down. So my work became quite quiet for a while. There's not a lot of deals happening when you've got a falling oil price. Once things settle, wherever they settle, things do start to kind of get a little bit back to something like normality. But when you're in the midst of that turbulence, obviously everyone's just like stand back and see what happens. And so, we had quite a quiet time at work at that point, which is quite nice when you've just had a kid. But at the same time, it's also quite stressful because you're thinking, well, what is without deal flow and without new projects getting signed off, then what's the requirement for people in our positions, right?
Yeah, 100%. And you're at the mercy of that oil price, and it's so sensitive to changes. So you're watching it every day and just hoping that projects will come back online and confidence will return. You feel powerless a lot of the time.
Yeah, that's right. And everyone wants to know what's your view on the oil price, like it matters.
Yeah, exactly. Like you can change anything, but I don't know. You just got to adapt. It's sort of life lessons, isn't it, for any industry? you adapt to try and succeed in those conditions, because you know that the good times won't always be there, but then neither will the bad times. So.
Yeah, no, that's true. It is, you know, it is cyclical. So was that sort of stress that comes from that sort of job, was that a factor in thinking about becoming an entrepreneur and starting your own business, or was there other things involved?
Yeah, I think so. I mean, the big one was kids coming along.
Yeah.
You know, I spent most of my 20s building my career, earning a bit more money each year, feeling a little bit better about yourself, like you're doing okay. And then when kids come along, all of a sudden you've got this income and expense line, and you keep the income line above the expense line. And then when children come, expenses just go through the roof, and you're looking at it going, what can I do? You know, and you look ahead into the future, the life you want to provide for your family, holidays, nice things for them. Do you want them to go to a private school? You know, things like that, that, you know, may not be what everybody wants to do, but we didn't want to limit that just based on our income at the time. And we looked ahead to the roles that we could move into in those industries we were working in. And it just didn't appeal to us, because whilst there might have been potential for more money, there was greater potential for more stress and more time away from our kids in order to get that income.
I mean, oil and gas is problematic in that sense. Like, it's very global, right? So a lot of traveling involved, which is not particularly great for families.
No, and particularly in my role, I was in sales and business development. So that's basically what I did all the time, selling engineered products around the world. And, you know, once you've had the chicken dinner on Emirates flight to Dubai once, you've had it 100 times. You know, the novelty wears off very quickly. Chicken or lamb, that's basically it.
Yeah. Well, it's like, I mean, the travel in itself is not fun. But yeah, as you say, it's the time away from family, which is, you know, so that was obviously a big factor for you, as it was for me, right? When I was, you know, when I started to think about this was, you know, it was really kind of when we started having kids. Like when we were in our 20s, you know, both of us working hard, didn't see probably as much of each other as we should have done, but we both were quite comfortable with kind of like the trade-off we were making. But yeah, as you say, once kids come along, and then, you know, it's time and also potentially money. So at what point did sort of starting investing in property kind of come into that picture, and was it sort of done sequentially whilst you were still both in your jobs?
Yeah, so we were working full time. We'd already had our first child. Heidi, our 5-year-old, was born in 2015. No, she wasn't. 2014. Oh no, wait. I should know this. Yeah, I think it was 2015.
Well, I would say I'll edit that out, but I don't know how to. So
they all merge into one. No. Okay, so we'd already had Heidi, and we were thinking about what we wanted to do. You know, a secondary income stream. And G was pregnant with our second, Edward, and he was due in the May. And this was sort of August or September the year before, and we just started chatting about it, really. You know, what are we going to do going forwards? And that got us on this sort of direction towards a secondary income stream. You know, and what could that encompass? Did we want to go into sort of building an online business? Did we want it to be in property? Did we want it to be in something else? And so that started the journey, but it was underpinned by this idea of creating a secondary income stream that meant we didn't have to necessarily work to get paid. You know, being on that wheel, working every single day, because if we stopped going to work, stop getting any sort of income, and that just felt very, very risky long term.
So at that point, were you thinking of it as an income stream to supplement your jobs, or to replace your jobs eventually, or a bit of both?
It was to supplement it. Like I say, G worked for Virgin Money, who are a great employer up in the Northeast. It used to be Northern Rock, so a very interesting story there over the last few years. But they look after their staff, and so she had a great work environment. And for me, I was in what many in my industry would probably see as like a dream job. I was a shareholder in a company that was private equity backed, and we were on a growth curve to float on the London Stock Exchange. And so to kind of be in that position within the management team, driving that forwards, and all these ideas that we had, it was a lot of fun. But I sort of thought to myself, well, why not? You know, a lot of people say, yeah, I love my job, I was like, well, let's really see if I love it. You know, would I do it for free? So if I could replace my income with something else, how much would I love turning up every day doing what I do?
Yeah.
And it was a very interesting experiment. And, you know, spoiler alert, I don't work in that industry anymore. So you can kind of tell what decision I came to.
So, okay, fine. So that's a pretty good sort of thought experiment. So, how did you sort of go about starting investing when you're both working full time? You've got one kid, second on the way. Like, how did you actually kind of jump into that? Because I think that's something that a lot of people have a problem with, is like, they don't want to just quit their job and start from scratch, which is pretty risky. But equally, they don't feel like they've got much time spare to get going on the side hustle, in the hope that the side hustle can maybe one day become the main hustle.
Yeah, it was hard. I won't, you know, I won't sugarcoat it. It was difficult, and we had to become very disciplined with the time that we had. And I think what we found was that actually, even though we thought we worked long hours and didn't have a lot of time to do this side hustle, like when you actually break your day down, like we do waste a lot of time doing stuff that isn't that important, or doesn't really add a lot to our lives. And it could even be just waking up an hour earlier, or just once you get the kids down, we would spend a couple of hours just disciplined, like looking at deals online and researching areas, speaking to estate agents and things like that, and booking in viewings. And so we just got into this routine, and it's that whole principle of like doing a little bit each week, even if it's a few hours, like it really does add up in the long term. So that was our sort of mentality.
Were you investing at that point where you lived? Did that?
Yes, we lived up in Gateshead, up in the northeast. And we just started investing on our doorstep, really, or within half an hour of where we lived. So so that made it a little bit easier, I guess, in many ways.
Yeah, no, I think like I invest. So you've moved now, haven't you? You don't live there anymore, is that right?
No, so we're about 160 miles away now. So
okay,
we're down in just South Manchester.
So I invest like near where I live. Generally, you know, some of them are sort of half an hour, 20 to half an hour minute drive away, and then actually what I'm doing at the moment is like a half-hour walk away. So that's quite good during a lockdown. Just go do your exercise and visit the site in one go. And I'm a big fan of that, because, you know, as you said, when you were starting out, you know, that if you can cut out travel time, then you can use your time a lot more effectively, right? And a lot of people are sort of, you know, they want to sort of rinse out the most they can from the deal on a financial metric, and, you know, look at investing hundreds of miles away from where they live. But, you know, if in doing so it actually prevents you getting started or doing as much as you could do, because, you know, just the logistics and the practicalities of that, then inevitably, you know, the returns might look better on a spreadsheet, but, you know, where are you actually going to end up on a sort of absolute basis?
Yeah, and it's always going to be like, practically, if you've got kids and busy lives, it's always going to be easier if it's a little bit closer to home. So if you can get it to work there, then great. But like for us, we had a strategy of getting to a certain point. So it didn't really matter where the houses were. We just wanted to make sure that once we got to this figure per month to replace our mortgage and gas, electricity, water, things like that, then once we hit that, we could just repeat that process again and again. So that was our big driver, really, sort of getting to that figure, rather than just let's invest in that area. The area was determined by the goal and the strategy.
Okay, got it. So do you still invest up there, or do you now invest more locally to where you are?
So a bit of both. We still invest up there, and it was something that we thought, should we move away from that now that we're down here? And but to be honest, like, we know the area so well, and now we're buying stuff on the same streets where we've already got houses, so it makes the numbers a bit easier. You've got relationships with every single person that you need to do the deal, whether that's the agent, a surveyor, insurance broker, even my accountants up there. You know, so a lot of our team, if you like, are based up there, and so we keep an eye on it. And I think part of our strategy up there is a cash flow strategy. You know, the property prices are very low, and the yields, the returns can be very high. So if I were to try and buy similar properties down in Manchester, I'd probably pay a little bit more, and potentially have to sort of go through that process all over again.
Yeah.
in learning those areas. So we've got a strategy that works up there, and then we've got a slightly different strategy down here in Manchester, and the two complement each other really.
Okay, cool. So you said at the beginning, you know, some buy-to-let, some HMOs. So how do you think about, because I think that's that's something that a lot of people want to do, is to have a balanced portfolio like that. So how do you think about sort of keeping those two in balance, if you do at all? Or is it just a case of, you know, a property comes in the market that you like the look of and you think you can get it for a good price, and then you decide, okay, this feels more like an HMO, this feels more like a single let? Is it, or do you have a sort of like, we want to keep it 50-50 type thing?
Yeah, I wouldn't really, I certainly long term don't want to be reliant on like more on our HMOs than our single lets. And I got nothing against HMOs, you know, we've got them and they're successful, but we found, and particularly in lockdown, like most of our challenges and I suppose time has been taken up dealing with the HMO side of the business, whereas our single lets, and they're all working professionals, you know, we haven't gone into social housing yet or that side of things, but our single lets are just solid, and you know, there's certainly lower risk, lower returns, but in terms of a longer view, they're just solid. And again, we kind of got into this because we wanted a bit more of a passive lifestyle, and it's certainly not passive, but it's passive, more passive than working actively every single day 9 to 5. And we just find the single lets provide us more of that life. So we'll continue buying single lets, and I think we want to get them to a point where we've got a really good base foundation, if you like, of income that's just coming from them, and then we sort of look at more of the active income strategies to generate chunks of money, such as the conversion projects or the land deals, to then feed it into more single lets and smaller HMOs. We like the smaller HMOs.
No, I think, I mean, I can completely understand that. I mean, you know, the management of HMOs, I think, is something that people consistently underestimate, and certainly I did when I started, and I think nearly everybody does, because even if people tell you, oh, they're quite hard work, you don't really kind of understand until you're actually sort of doing it, right? Whether that's you self-managing, or even just, you know, you've given them to an agent, but you're still involved in, you know, this has happened, that's happened, you know, they're just it's just a completely different beast, right? So do you see them as like, you know, it's a means to an end? You know, you getting a few HMOs early on obviously accelerates getting to that sort of cash flow number that you wanted to get to, but, you know, looking forward, you don't want to massively increase your exposure there. Would you even consider selling some of those, do you think? I mean, you know,
I think so. I think so. And I'm sort of looking at the next 5 years. I look around at like the property investment market, see a lot of people entering the market, particularly the HMO market, and they're coming in with maybe quite a bit of money in the bank, and they're throwing it into a property and thinking, I'll make it top spec, get the highest rents and all of that, which is fine. But I think, you know, what I renovate today, in 5 years' time, what am I going to be competing against? And so our sort of model has always been, our prices, like, we're not necessarily getting the top rents in the area, but we're also going for like the lowest either. And what we offer to the market seems to be really well received, and it's perhaps sort of £50 or maybe 50 or 75 pound below what we might be able to get if we really kind of went for it, you know? And I just think, like, long term, I want to sort of have more of the single lets, and then fund them from developments, and maybe do the odd minimo 4-bed, 5-bed, 6-bed, and HMOs to build to sell, or to source on.
Okay, that's interesting. I mean, so on the single let front, I mean, you know, I'm in a position where my portfolio is exclusively HMOs at the moment, but the plan is to diversify that and focus more on single lets at some point in the near future. Do you sort of differentiate in your mind between sort of flats and houses and the tenant profile, families versus younger people, maybe? Do you have a sort of any thoughts around that?
So we have flats and houses, 2 beds and 3 beds. I like them both. I do. There's a few areas we invest for flats, and they're great. I really like them. I think the only main difference is you often tend to get families more in the houses.
Yeah.
And in the flats, it tends to be a single parent or someone on their own. But yeah, I often find the deals stack a bit better with flats. And maybe that's just because, I don't know, I can add a little bit more uplift on them. But I tend to find out I've got more potential deals in my pipeline that are flats than are houses. Okay. So I don't necessarily know why that is, but yeah.
That's interesting. So just going back to something you said at the beginning about, so you're thinking about this other income you wanted to generate, and it wasn't sort of automatically property. What were some of the other businesses that you sort of spent serious time thinking about at that time?
To be honest, I don't know how much serious time I looked at. I certainly looked at like selling stuff, because I was in sales. So I was like, what else can I sell?
Yeah.
I started looking around. But there was a lot. I just like the idea, and maybe this was sort of my engineering mindset of sort of when you break it down, property, you're dealing with something physical that you can see, touch, and feel. And I just could never get my head around doing something that I couldn't, and that just seemed more like service or product driven, where I had to keep feeding the beast, if that makes sense, and like generating sales to create the income. Whereas property, it was, if I can do the work now, then in theory it's going to pay us long into the future. And the biggest challenge I think that I had was, I was degree qualified, master's in engineering, mechanical engineering. I was chartered. I had all the digits and stuff, and I was selling these highly engineered, sophisticated products into the subsea industry. But like, if I wasn't selling, then I was potentially at risk. Like you live and die by how successful your results are. And I was just thinking, if I applied that same energy into something like property, every time you get a win, that's another asset that's in your name. It's yours. It's not an investor's or necessarily, or a shareholder's, or the chairman's or something like that. Like, you're building your legacy for your family. So I really like that. And so it wasn't a long drawn out process looking at loads of other things, if I'm being honest. I thought about consulting in the same industry I was working in, but I just, property was that thing of like, okay, my family member my dad had experience in it, and so that had always been a little seed in my life of like, let's do something with that one day.
Yeah. Okay. Yeah, that makes sense. I mean, so I came to property sort of via trying another business, which was sort of in that sort of selling stuff.
What was that?
So it was like a nutrition business.
Yeah.
And what I came to realize is that actually I didn't really want to have a sort of, a business where I had to build out a team around it and raise equity and all that kind of stuff, and really, create a new sort of job. Be it, it would have been a fun job. But, I think I started off thinking I wanted to be, a sort of an quote unquote entrepreneur. But actually what I realized is, I wanted to, do something where I wasn't sort of, trading time for money. And actually, if you want to create that sort of, as I say, it's not passive, but a sustainable sort of, continuous income stream. Yes, it's going to require some time. Yes, it's going to require some reinvestment. Some of that cash has got to go back in. Otherwise, the quality is going to go down, etc.
Yeah.
But it needs to be asset based if you want to get out of it, right? Because otherwise, if you're trying to sell stuff on the internet, like as soon as you or whoever in your team is doing, the Google ads and the Facebook ads is off sick, like you can forget about it, right? It's just gonna grind to a halt. So yeah, I think pretty sort of similar from that perspective. And also, I mean, a lot of people are interested in getting into property, clearly. I mean, you and I and lots of other people who are, relatively small in this business, but, there are people sort of following us on social media and stuff. Why do you think that is? Is it just for the reasons that we've outlined, or is there anything else that's going on sort of in culture or in, in society that you think is kind of like pushing people in, or making people really interested in this? Or maybe it's just always been the case. This is like something that people want to do.
Yeah. Well, I think everybody has an interest in property because we all live in some sort of house or home. So the people that reach out to me generally like say I've always had an interest. I think the other thing is that this, maybe right now with the lockdown, it's got a lot of us thinking about like, what am I doing with my life, and actually they're probably getting spammed as well by a lot of Facebook ads of people selling their courses and their wares, and maybe they think they've just thought about property, but actually they've been targeted by these. But yeah, so I think there's that, and I think there's maybe a little bit of an element of like taking control back. Perhaps we're seeing just how sensitive we are to fluctuations in the economy, and that is a job really that safe anymore?
Yeah.
If times get tough, people get sacked, or regardless of the amount of time they spent with a business, and maybe people are just saying, do you know what, I don't need to necessarily rely on that particular company, like putting food on the table. I can take control back. And I think that's a very attractive thing for people to know, that they can be the driving force behind that, rather than that paycheck that comes in from someone else every month.
Yeah, no, I think so. I mean, quite a lot of people at the moment are getting their paycheck from the government, right? Rather than from their normal employer, or via the furlough scheme. So, that's that feels quite nice at the moment, but whether that's obviously not sustainable. And before we sort of flip over to some questions that some people sent in before this, what do you think about sort of property in the sort of post or during COVID kind of environment, like next 6 to 12 months? Are you still buying? Are you being cautious? Are you waiting to see a bit more data? How are you sort of thinking about that?
Yeah, I'm still buying, but maybe I'm changing the way that I'm trying to buy. I think it's probably the best way to say it. So I found that I did quite a few viewings pre-lockdown, which resulted in negotiations and offers. And it was very interesting. Quite a few of those offers before lockdown were cash within 4 weeks, and they got rejected because they had other buyers and they weren't interested, and this, that, and the other. And then lockdowns happened, and all of a sudden, like, tables have turned. And I've had a few calls back from like auction houses, vendors that I was chatting to direct, who are saying, look, yeah, is your offers still stand? They're willing to move forward with it, or they're not even bothered about cash anymore. They'll do it subject to planning on some bigger deals. So like, I've seen a big shift there, and I think going forward, I'm going to be spending a lot more time looking at how the deals are structured, because I think there's going to be a lot of deals hit the market, and I don't have vats and vats of money to dip into to buy everything.
Yeah.
So I want to be a bit selective about what we do, and try and get the best deals, but also get them on terms that work well for us, such as option agreements and or perhaps exchange with delayed completion, where we can sort of reduce our risk a little bit to ride out the storm. But yeah, I think the market's definitely changing. Do I think there's going to be an early recession? I don't know. We're definitely seeing down valuations, aren't we? So, they're just going to happen, and I'm expecting one of them on one of my HMOs. But I'm just going to keep ploughing forwards and keep building what we're doing, and try and roll with the punches and adapt. Because I think a lot of amateurs, a lot of people will get fearful, and I think for those of us that see that opportunity, that there's definitely positive things that can come out of us, and deals to be done.
Yeah, no, I agree. I think that it's going to be quite interesting to see, as and when. At the moment, there's not a lot of viewing. Viewings aren't really happening very much, right? Particularly in sort of traditional kind of residential stuff. So as and when kind of the agents do open up and get going again, how they're actually kind of advising their clients, relative to value expectations. I think it's going to be hard to argue that a valuation that an agent gave you, 2 months, 3 months ago is still valid, right?
Yeah.
But we know what happens where sellers get sort of they get wedded to a certain number. If they don't have to move, then typically they decide to wait it out, and you just see transaction volumes go down quite a bit. But equally, I agree. On the demand side, a lot of the sort of the flakier, newer, just there will be some buyers who you were competing with 3 months ago who will have fallen away, and that can only be a good thing, right? To have less competition, because stuff gets overbid all the time. So having a bit of a sort of reality check on some of that will be quite a good thing, probably for sort of professional investors.
Yeah, and I think that volatility, nervousness, anxiety in the market, can be something that can help you. If you're someone who's if you're clear on your numbers, that area works, you can take the opportunity to renegotiate, and capitalize on that. Just depends how ruthless you want to be, really, doesn't it?
Yeah, well, I mean, I don't think that's necessarily that might have concerned some people. I think, at the end of the day, if you make someone a fair offer, then it's, it really is up to them whether or not they want to take it. I mean, I mostly buy on the open market, which means that, it tends not to be people in high distress, because if you're a highly distressed seller, you probably don't go to an estate agent in the first place, right? Like, there are other people who can solve that. I mean, do you sort of do any sort of direct to vendor campaigns and that sort of thing, or?
Yeah, we've started doing more, and most of the stuff that we bought to date has been on the open market, like yourself. Quite a bit of it's been auctions as well. I really like auctions, particularly if they're being sold by a bank, and in that case, it's quite often it's sad circumstances as to why somebody's not in that property anymore.
Yeah.
But you're then dealing direct with an organisation, a company, and so it changes the playing field a little bit in the way that you can deal with them. And so we do both. And I think what we'll end up doing is looking to move more towards the direct to vendor route, because I'm seeing quite a bit of success there. Although I'm by no means any expert. I mean, I'm not your Facebook ad guy. Okay, yeah. I'll write a letter and post it through the door and knock on it, because again, that's kind of come over from the corporate world. I built the oil and gas division of the company I work for. We had no traction in the Middle East, and so the first thing I did was book a flight to Abu Dhabi, and I went to one of the biggest oil and gas shows out there called ADIPEC, and I just went and met loads of people. I had no USP, I had no experience in that company, but I knew getting in front of, in that case, it's like the vendor, if you like, or the seller. I needed to build that relationship, and I've just transferred that into property, really. So build relationships with people.
Yeah, you just got to pound the street sometimes, haven't you? Cool. So let's do a few questions from people that sent them in before we sign off. So got a couple of good ones, actually. Well, we just actually talked about this, I suppose, a bit. Daniel Godwin sent in a question: any specific sourcing strategies or processes? So yes, you do a bit of sort of direct to vendor stuff, and you want to do a bit more.
I think the one thing I'd say there is I wish I'd done more direct to vendor stuff sooner. I think I put it off, really, by thinking it was a lot of effort and I wouldn't necessarily get the return. But I'm seeing other friends of mine, investors, and also now seeing it myself, getting some good results online. These Facebook ads, there's a lot of people doing well out of that, and attracting sellers off market. And I think when you can remove all your competition and work out a deal that works for you and the seller, it's win-win. So I think I'd have got into that a bit sooner. And just to be clear with the guys asking the question then, and my understanding of this would be, if someone is engaging with you on a direct basis like that, is it 9 times out of 10 or pretty likely that, they have a timing issue that means they need to sell quickly? Because otherwise, why wouldn't they go to an agent and market it for a month and then do 3 months of conveyancing? I think it can vary. Some people just don't like estate agents.
Yeah, well, that is a factor as well, yeah.
I found that, and they just don't want the hassle. They don't want people walking through the house, having viewing days and then getting lowballed and negotiated down and that whole drawn out process. So, we've had a few conversations with people where they've just said, look, here's my situation. This is what I'd like to get out of it. And then we've said, well, let's see if we can try and get to that. And really, price is the last thing I would sort of mention or talk about. I try and find out what they want from the deal. What's your ideal scenario here? Yeah. And then I come at it from that sort of angle of, can I help you meet that scenario?
Yeah. No, to be fair, your point about agents is a good one, because actually, although I haven't bought anything direct to vendor, I have had situations where I've viewed a house through an agent, and then, you know, a year later, I've gone back and sent them a letter and said, by the way, because I know they haven't sold, you know, by the way, if you're still interested, I'm still interested, so let me know. And yeah, I have got callbacks and gone to meet them at their houses to have a further chat about it, and actually saving the agency fee, which on a, you know, 400, 500 grand house is quite a lot of money, is actually quite a big motivator for them.
Yeah.
So yeah, no, it's it can take all sorts of situations that people would sort of engage like that. Got another question from a guy called David. So he's asking about basically adding value to properties. He's got a house that he could do a loft conversion on, and he's wondering whether he wants to do it. So I was just wondering, because you and I invest in very different parts of the country, sort of northeast to southeast. So how do you think about sort of adding? Do you add square footage to your like your houses, or your single lets, or your HMOs, or?
Yeah, it depends. Normally we don't add it to our single lets, because I sort of look at it, and a loft conversion sort of 15 grand, 10, 15 grand. I don't know. I don't know what prices are like where you are, or wherever, but I would look at it and go, what am I going to put in that loft? And is it going to add sufficient value in terms of the money I get back every month to justify spending the money to convert it? So certainly wouldn't do it on the single lets. I think on HMOs, if you can add a couple of bedrooms, great. But then if it adds one bedroom and you get in, and I know you'll probably get double this, but I suppose a sort of typical monthly amount on a HMO might be like £500 a month. If you take that over the year and then take your costs off, you know, how long would it be till you get back the money it's cost you to convert that loft, really? So I think you just got to look at, will you see the return on that money, or is it better to just leave it, have one less room, and slightly less per month, but maybe you've got more money to do another deal?
Yeah, no, I think that's exactly right. I mean, it's really about understanding your market, understanding your objectives. You know, what are you going to, you know, if you put that money in, you know, it's really just like, you know, this is just a machine where you put money in and then you get money out, and you want to get that ratio you know, in as favorable a sort of place as you can. So yeah, for me, you know, I generally do extensions and loft conversions, because, you know, an 8-bed HMO where I am is getting valued up at 800, 900 grand. So each bedroom is worth 100 or 110 grand, right? So if you do a loft conversion and it adds 200k to the end value of the property, then, you know, you're probably going to do that all day long. But, you know, that's why it matters, you know, what are you doing, and what sort of value is it going to into it? So
I think it's good. It can work really well for your own residential property, like where I live. It definitely makes a difference. The square footage, the total square footage, you've almost got an exact number for it that you can just multiply it by and know what your house is going to be worth. So families want a certain amount of space, whether that's 2,000 square foot or more, and that's a really good way you can add value, because the cost, depending on the area, could actually, you could end up getting double, treble, quadruple the value.
Exactly. You know, if you can exploit that arbitrage, then, you know, I think it's a winner. But, you know, that arbitrage actually needs to be there for it to make sense. So actually, we haven't touched on investors, so let me do this one from Amit. So done a few buy-to-let refurbs, I guess single lets. Worried that I'm going to run out of money as I can't get all my money out each time. So I think basically he's leaving a bit of money in each time. His cash pot is coming down. Should I sort of, before I run out of cash, should I think about doing JVs going forward? I mean, that's a very specific question, but like, how do you think about investors, JVs versus private investors? Is that something that you do, or?
We've never done a JV.
Yeah. And, want it all to yourself, yeah.
Well, it's not so much that. I know too many people that have had JVs go wrong.
Yeah.
And it's a bit like, I don't ride a motorbike because I know too many one-legged people. But I think with the JV thing, look, of course they work, and they work for a lot of people. From what I've sort of learned from how other people have structured them, I think they can work really well if you've got an exit.
Yeah.
Meaning, if you're buying something to add value and sell it and make it a clear profit, and there's a clear exit strategy, you can share the profits and off you go into the sunset and job done. I'm a bit uncomfortable with how that works long term with a JV partner when you're doing all the work basically. And so I think a lot of the time you're sharing it 50-50 with someone who's probably never going to see the property, have no involvement in the day-to-day running of it. And I just wonder, you know, when does your sort of patience run out 5 or 10 years down the line? And you feel like maybe you've undervalued what you can bring and perhaps they've overvalued what they're bringing. So
yeah, and the other issue with that is, you know, in 10 years time, you're financially maybe doing better and you're like, why did I ever do this deal in the first place? You know, it's that old joke about, you know, you go to the restaurant, you order all this food, and then at the end the bill comes. Well, I'm not hungry anymore, so why am I paying for this food? But like, you know, so I do think that, yeah, I've had the same sort of thoughts. Like, I would do a JV on a flip or a, you know, a conversion to sell something, but to for a long-term hold, either a single let or an HMO, yeah, you've got to have the right person there as a joint venture partner for a start.
Yeah, you've got to know them. You've got to have a good relationship, and I think someone said it to me once, like, you know, you've got to be not just comfortable enough to have a cup of tea with them and share a meal with them, but spend the weekend at the house, you know. If it's going to work long term, you know. Maybe that's true, maybe not, I don't know. But I think the idea of it being with somebody you have that sort of trust element with long term. But the main thing I would say is, you know, really value what you can bring to the deal. Like, a lot of people don't have the time and do have the money, and there's going to be a lot of money out there going forwards, and that there is already. And so just weigh up whether it's worth it to you, or whether you put in a bit of work and find an angel investor, or do some sourcing to build up a capital pot. Like, just have a look at the options, really.
Yeah, no, that all makes sense. I think on the, you know, the other, we've talked about it much more from our point of view, or the investor's point of, the sort of the developer's point of view, if you want to call us that. From the JV, from the other person, you know, the person that's bringing the money's point of view, the deal's got to be good enough that if they're putting in all the money but getting 50% of the return, you know, that's got to be quite a good deal to satisfy them as well, right? So, you know, it's not as easy as saying, well, I'm just going to go and get a JV partner. Like, you've got to come up with something pretty solid, you know, that's going to kind of make sense, because, you know, whatever that return would have looked like on a 100% basis, basically they're going to get half that, right? So
yeah, I think where I would feel more comfortable is if they had quite a bit of money and you did you set it up by saying, look, we'll do a few deals together, but we'll buy one, you buy one. You know, it's that kind of thing. So rather than sort of 50-50, you're still doing 50-50, but they've completely owned something and you've completely owned something. How exactly you structure that, I don't quite know. Tricky. But, you know, I'd feel a bit easier about being able to go our separate ways, a bit simpler. Yeah. But then obviously one of you is going to get the property first, aren't they? So
yeah. So I think it's on that then. There was a question that I got in the week, and it wasn't related to this call, but, you know, it seems relevant then to talk, seeing as we said, you know, you don't do JVs, but you do use private investors, presumably therefore on like a debt basis. So, you know, this guy was, I think it was a lady actually, she was asking me, you know, why is everyone going on and on about investors? I think she means on social media basically, because, you know, there are refurb development lenders, bridge lenders, all these companies where you can raise debt capital. So what's the big deal about investors?
Yeah. So for me, I just see it as a little bit more straightforward in terms of, like, the security aspect is always a discussion that you have with that particular investor. And I think when you go down this sort of institutional lending point of view, then it can be a more drawn out process. They want charges on the property. They want you to pay all their legal fees and surveys and stuff like that, which is fine. And we do that.
Yeah.
But I just find with the angel investors, that it's a bit of a more straightforward setup. And also, I don't know, it feels good being able to sort of make money, not just in deals that you're going to do for yourself, but also for your sort of wider network of people who maybe don't know or I've just had money sat in the bank, and you can actually provide them a phenomenal return, which could give them a great holiday each year, or a donation if they want to give a donation to a charity or something like that. So it's a bit like, if you're going to make money for somebody, why do it for a faceless organisation? Why not partner with someone and you can make them a much better return?
Yeah, no, I agree with that. It's definitely nice to pay interest to a friend or an acquaintance that you like, rather than to a sort of faceless organisation. I think also, like investors, I work with investors on a an interest loan basis, and it is it's just much more flexible than an institutional lender. Like, you won't have, there won't be a drawdown process to release your refurb funds. Dog's looking out the window. There won't be that. There won't be. You might have fewer fees, although depending on the interest rate, they might sort of come out in the wash. But I think the other thing is, if they're happy at the end of the deal, they'll quite likely roll over into the next deal, and so you can kind of you can just have those bespoke conversations. Whereas a lender's going to be like, that's not our process. We've got to repay that one, new loan, 8 weeks, solicitors. So it is. I think it maybe gets, if you're coming from the outside and you're seeing everyone bang on about investors on Facebook or whatever, you might be right in the sense that it's like getting, those benefits are there, but they're not necessarily the be all and end all. Like, you can do this without having private investors. I believe. But there's a reason why it's a popular way to go, and it can make life a bit easier. And it can, whenever you've got more flexibility, it allows you to be a bit more opportunistic as well. Like, if you find something that you like, you may have somebody who can give you cash in a week, which is going to be quite difficult to get from an institution.
Yeah, well, and just look at lockdown. A lot of the institutional lenders are pulling out. On deals they've agreed on, and they've just slashed the loan to value, or they've just said, no, we're not doing it. So, that's not to say that wouldn't happen with an angel investor, but actually, I think what we're seeing is, if you can continue offering the great rates that you can give even during this time, then you're going to be a very attractive option.
Yeah, I agree. But there are some investors who are getting nervous as well. So, it's kind of, it's horses for courses, but hopefully you can keep, there's always going to be, you've got to find people that see things the same way that you do, right? Like, if you think it's the right time to carry on buying, then you just got to find investors who buy into that thesis of, why you're right. And that's just generally the case as well, right? Like, no investor's going to give you their money just generally if they don't sort of agree with your business plan and what you're trying to do. So it's just kind of finding people that are aligned on all of those things.
Yeah.
Awesome. Well, look, I think we should probably wrap it up there and carry on with the day. But thanks so much, Charlie, for doing this. It's been really good to finally connect and have a good chat.
Yeah, thanks for having me. I think that was great. Apart from forgetting when my daughter was born, it all went pretty well, didn't it?
Well,
it was 2014, by the way.
Do you want to give us a day and a month on that, or no?
Oh, now you're testing it. Yeah, 15th of September.
Well, I agree. It's much harder. It's much more difficult to remember the years than it is the days.
Exactly.
Right. But cool. All right. Let's leave it there. Thanks so much, Charlie. Have a good one.
Thanks for having me. Great to chat. See you
Bye.
soon.